If you're having trouble with understanding mortgage loans for your UBC real estate licensing exam, you've come to the right place. This video is one of 8 videos that we'll be uploading for free to ensure you build a strong foundation for the math portion of your UBC real estate exam prep. Now, all the videos that we'll be uploading to this playlist are from our real estate licensing tutorial course over at excelrealtyacademy.com. So if you find this video helpful, but want a more personalized experience in your journey to becoming a real estate agent in BC, we put a link in the description of this video so you can compare the 3 programs that we offer, which have helped thousands of people go from overwhelmed to fully licensed real estate agents. Now, without further ado, here is the mortgage loans overview lesson. Enjoy. Hello and welcome to chapter 13 and 14, part 1. And this is going to kickstart the math section of this course. And this video is about mortgage loans. Now, people call this the math component, and sometimes people get scared by the word math. But here's the good news. It's easy to learn. We're going to teach you how to use the HP 10BII calculator, show you the key functions, and with time and practice, this will be very easy for you. So before we jump in, let's cover our disclaimers. This presentation is copyrighted by Excel Realty Academy. It is to be used only by the students who are currently enrolled in our program. You agree to not record, copy, share this presentation in part or whole, and the content of this tutorial course does not constitute any legal or professional advice. Now let's jump into it. So in this course, we are going to focus a lot on mortgages. Simply, a mortgage is when someone borrows money to buy property. The property is pledged as security for the loan. If the borrower cannot pay back the mortgage, the money owed can be received by seizing the property. The definition we're going to use is: a mortgage is an interest in a property created by a contract. To get a mortgage, a person will apply for a loan. And if they get approved, the bank will give them the money. Once approved, the bank will have the borrower sign a mortgage contract, and the bank will register the mortgage on the borrower's title as a charge. By doing so, the bank creates interest in the land, and that property is pledged as a security for the loan. So a mortgage is not the loan itself, but it is the evidence of the loan or a debt. The parties in a mortgage are the mortgagor and mortgagee. The mortgagor is the borrower or homeowner, and the lender or the bank is the mortgagee. The mortgagor uses the mortgage to buy their home. The bank uses the mortgage as an investment to make money. Now, there are many types of investments available, and a mortgage is just one of them. Other investments can be stocks, bonds, and commodities like gold. Mortgages have several key characteristics. The first one is that mortgages are illiquid, meaning they cannot be easily converted into cash. They can't be easily bought or sold. This is because the lender is tied to a contract with the borrower for a fixed term, like 3 or 5 years. Other investments, like stocks, can be sold much quicker. Now, another characteristic is that a mortgage will have extensive initial and ongoing administrative work. Before lending money, the mortgagee must investigate the mortgagor's credit rating/history, their source of income, their ability to make payments, and investigate the property that is being purchased. After the mortgage is approved, the administrative work continues. The mortgagee must collect payments, ensure property taxes are paid to protect against government liens being placed on the title, and verify that the property is insured to protect against damages. The administrative work is done to protect the mortgagee. Next, a mortgage requires a large sum of capital. We can invest $1,000 into gold, bonds, or stocks very easily. But people wouldn't borrow $1,000 for a mortgage loan. Having a mortgage business, then, requires large amounts of money. Even $100 million may not be enough. If we lend $1 million to each borrower, it just takes 100 borrowers and our money is drained. Now, the next characteristic is that it is a long-term investment. We're stuck with the borrower for the length of the term, which is normally 2 to 5 years. And the last characteristic is that mortgages are unique. Unlike gold, where 1 ounce of gold is the same as another ounce of gold, mortgages are unique. Every mortgage loan is different. Someone may borrow $500,000 for 15 years. Another may borrow $1 million for 5 years. People can make monthly or weekly payments, and people can also have different interest rates. So those were some key characteristics of mortgages. Quick pause. Mortgage terms can be a very difficult concept that many people struggle with. So that's exactly why we have curated a bunch of practice questions and additional study materials in our courses at excelrealtyacademy.com to ensure that our students ace it. Now back to the video. Now, a mortgage has 2 key items that we must understand, and they are the amortization and the term. Amortization is the total length of time that it will take a borrower to fully pay off the mortgage loan. Normally, it starts with 25 or 30 years. Now, second is the term. The term is an equal or shorter period of time than the amortization. The term is the length of time that the mortgagor keeps the same interest rate. So let's say the mortgage is $1 million for 25 years with a 5% rate for 5 years. Therefore, the 5% rate stays for 5 years. After the 5 years is up, the mortgagor can pay off the full loan or continue the loan. Therefore, the 5% rate stays for 5 years. After the 5 years is up, the mortgagor can pay off the full loan or they can continue the loan. The mortgagor can switch lenders and will have to negotiate for a new rate and a new term. During the negotiation, the rate, length, and amount can all change. If the rates go up, the payments go up. If the rates go down, the payments get smaller. If the amortization is extended, the payments also get smaller. If the amortization is shortened, the payments will get bigger. For future lessons, it is important to remember that the term does not impact payment. When we do future example questions, we use the amortization length for payments. Whenever we have a term for a mortgage in a question, we must draw a timeline and put the term on the timeline. The term has nothing to do with the payment. It only goes on a timeline that we have to draw, and it is related to the outstanding balance. And don't worry, we will cover that in future videos. Now, if the term is shorter than the whole amortization period, we call this loan a partially amortized mortgage. But if the term and the amortization are of the same length, we call this a fully amortized mortgage. And in this situation, the loan is fully paid off by the end of the term. Now, for a 25-year amortization mortgage with 5-year terms, the first term is from year 1 to year 5, the second term, year 5 to 10, the third term from years 10 to 15, fourth, 15 to 20, and fifth, years 20 to 25. Now the fifth term is fully amortized and will be fully paid off with no outstanding balance. Now briefly coming back to outstanding balance, this is an important term related to the term. The OSB is the money owed at a point in time. During the loan, payments are made towards interest and towards the principal. Over time, the payments change the value owed. So to go over all the important mortgage items, we need to know the interest rate, which is IYR% on the calculator. We need to know payment and payment frequency, which is PMT. This is how much is paid and how often. Then the loan length. This is N for how long the loan is. The present value. This is PV. And it is how much all the future payments are currently worth. Normally the amount borrowed at the beginning of the mortgage. And then the future value, FV. And it is the amount paid/owed or the amount to collect at the end. Now this brings us to the end of the video. Thank you very much for watching, and we'll see you in part 2. If you like this video, you'll love the next one in our playlist. And if you want to take your UBC real estate exam prep to the next level, make sure to click the link in the description and check out our programs. Bye for now.